going, guys. Right, so if you guys remember, then when it comes to candlesticks, right, we mainly use candlesticks to do analysis, as candlesticks are much more visually appealing than line charts, boom, as well as bar charts, boom. Okay, so if I were to sort of, okay, let's see. Let me just change this very fast. Let's use a dark green, bull candle, dark green, because some of you might be familiar just with this sort of setup. Okay, so just to make sure we're on the same page. All right. Now, this is much more visually appealing than your normal bar chart and, of course, your line chart. Okay, that is why we use Japanese candlesticks. They relay the information to us in a much more visually appealing manner as opposed to the other two methods to interpret what the market has been doing in the past. Okay, now what you need to note is candlesticks can't tell you the future. They don't tell you what's about to happen. Right? They are merely a representation of what the price has been over the past hour, the past minute, the past year, the past decade. So candlesticks are just mere representations of past price action. Okay. Now, there are a lot of ways to use candlestick patterns, right? Or there are a lot of methodologies that utilize candle patterns rather. And when I say methodology, don't get confused, as that simply means strategy. Okay, I mean, it's just the way I've been taught how to talk when it comes to certain things, so don't get confused too much. Okay, Edmund, I think you're going to need to either type your question or click on a button that says join audio, or click to join audio. A button somewhere there, because at the moment I can't unmute you so you can talk. So you need to look for a section or a button rather that says click to join audio or join audio. Then I'll be able to unmute you and you'll be able to have your question answered. Okay, if you guys can hear me, just type Y for me. If the audio is okay for you guys, just type Y. Someone says they can't hear me at all. Because as far as I can see, the volume is actually very high. And I have my mic today, so you just type Y or yes if you can hear me in the chat. Okay, perfect then. All right, so I think that might be one person's issue at the moment. Okay. Okay, perfect. Yeah, it seems like everyone can hear me. All right, I think Edmund will have to log out and then log back in. Right, so now let me get my drawing tools together. All right, there's our rectangle, boom, and here is our trend line. Okay, we'll change colors in a moment, but most important thing is the actual structure and what it actually represents. All right, so if you look at this, all right, you have, okay, yeah, everyone can hear me. So if you're looking at this, the blue section is that's called the body, right? In this sort of template or layout that I've picked out, this would be the dark green area over here. Okay, so that is the body. And the wicks or the shadows would be the yellow lines, right? So those would be what we call the shadows or the wicks, or sometimes the pins. I usually call them the pins, right? And you'll hear when I talk about, I usually speak much more enthusiastically than this. It's just that I've been told that when it comes to more the basic stuff, I go too fast for some of the guys to actually keep up with me. So I'm going to try and restrain myself, right? Not go over the top too much, but if I am going too fast, please just let me know, guys. So this blue area over here, that is what we call the body, and these yellow lines at the top and at the bottom just represent where the price has been. Okay, so we'll take a closer look. The markets are moving quite nicely, so we'll be able to do so right now. And it gives us a representation of where the market peaked on the upside, right, and where the market peaked on the downside. So if this is an up candle, meaning the candle is green, that means it opened low and closed high. Okay, so I know we've done this, but we just need to do a quick recap. So the low, okay, on a green candle, you can see here, boom, this is where the market closed. At the body of the candle is where the market opened as well as closed. So on a red candle, it will just be the opposite. The open will be at the high and the close will be at the low. And the market closed, opened rather, right there. And then it dropped down and it peaked low there and it peaked high there, and then the market closed, boom, right over there. Okay. And then when that 1 hour candle closed, right, so after an hour, this candle closed and the next candle opened. Boom. And it peaked at the low here, rose to those highs, and then came back to close there. So if you're looking at what a candlestick basically represents, I mean, in its simplest form, and you guys know I prefer doing things in a very simplified manner, the candlestick just represents that previous buying and selling. Okay, it just gives us an idea of what's more, or who's more, I can say all in rather. Okay, so in a scenario where we see an extended move to the upside like this, we can safely say that the buyers are actually winning. All right, so the buy side is influencing the price to rise. As I usually use the laptop example almost every single week. If a laptop costs 1,000 Rand, right, so the cost of the laptop is 1,000 Rand, and all of a sudden there is an influx of buyers for that 1,000 Rand laptop. Now naturally the price will increase, okay, because there is a much higher demand for that particular brand of laptop. So there is actual space on the upside for the price to go up. Now, if there's a lack of interest in buyers for that laptop, so let's say the laptop is released, it's 1,000 Rand, and all of a sudden, no one cares about it. All right. Now, that means that there's a lack of demand for that particular laptop, and therefore the price will most likely decline. All right. Now, what you have to understand is that obviously within the trading sphere or within markets, there's a lot of different participants entering and quote unquote playing in the markets. Okay. I always say the market's high game, right? That's why I say quote unquote, because that basically means it's not actually really a game, right? serious business and should be treated as such. And anyone who treats it like a game obviously won't make any money. But what I'm saying is there's a lot of different participants within the market on a day-to-day basis. You have retail traders trading from their laptops, trading from their phones. You have people or banks in England, for example, looking for liquidity to buy, I don't know, bonds in a different country. Let's say bonds in South Africa, so they need to exchange some of the pounds that they actually hold for the South African rand. So they'll be able to buy bonds, government bonds, and all that stuff. So there's a lot of different participants within the market, right? You have institutional traders, guys who are actually sitting on their platforms every single day, 8 to 5, working and analyzing markets to make money for the bank that they trade for, or the hedge fund that they trade for, or the pension fund that they trade for. So they're all trying to extract money from the market. So, I mean, predominantly the market has become a sense of we are trying to make money from the market, and there is still that foreign exchange sort of historical background, because the markets weren't created, or the foreign exchange market wasn't created to make money. It's not a wealth creator. It wasn't designed to be that. It's just basically so someone in England, right, who wanted to invest in the country can exchange their pounds for South African rands and invest money into the country, that sort of thing. Right? Now, it's not just country. I mean, even if you go on a trip and you take money from here, South African rands, obviously that'd be useless if you go to Great Britain. So you need pounds. You purchase pounds using your South African rands, and that facilitates the foreign exchange transaction. Okay, so in its basic sense, that's what the markets were designed for. So if then there's a lack of interest in the market or in that particular, so if there's a lack of interest in that particular market, right? So right now we're looking at the euro versus the Australian dollar. Okay, this is on a 1 hour time frame. These candles represent or tell us a story of what happened within the past hour. So 1 hour ago, 2 hours ago, 3 hours ago, 4 hours ago, 5 hours ago. Okay, so for the past 5 hours, the market has been pushing upwards. Now that is something that can be of very importance, okay? Can be something of importance, and therefore we should take light of it. We should take note of it and be like, okay, we recognize that the euro Australian dollar has been rising for the past 5 hours. What does that mean, or how do we then take advantage of that? Okay. Now, that's when candlestick patterns come into play. Because once you can identify what the market could potentially do before it actually does it, you can then profit from it. Because imagine if you had bought the Australian dollar, US dollar, boom, here, right? Let me clear that up. If you had bought the Australian dollar, US dollar over there, then you'd have 1, 2, 3, 4, 5 hours of the market rise. Right? You'd be smiling right now. All right. Now that is the overall objective of what technical trading can provide. So reading price action, reading the candlestick patterns can present an opportunity for us to take advantage of the market before it actually rises. That's the whole objective. That's the whole point. If you can do that on a consistent basis, you will be rich. Right? Now, it's not about being right all the time, Because sometimes you can actually be right about the market and still lose money. And you can be wrong about the market, you can actually make money. But that's just an entirely different topic in and of itself, which we'll cover extensively with the advanced sessions much later on. But for now, how to be able to get this information and turn it into something profitable. So with that in mind, we look at some very basic candlestick patterns. Okay. Now, I know that there's quite a few that a lot of guys follow on a day-to-day basis, weekly basis. I mean, there is, I don't know, there's ones with elephants. I mean, it draws an elephant. I don't know how that one works. Okay, let me just try and make an example. Yeah, there's an elephant. Apparently, it draws an elephant, and then there's a trunk, and then I think the tusks or something like that. And there is the head and shoulder. Okay, the head and shoulder is one of the most commonly used one, right? So there's the left shoulder, and then there's the head, and then there's the right shoulder. And if the market comes in and breaks below, then you actually sell. Yeah, I think you sell at the break of this shoulder, or some people choose to break on the shoulder itself. Oh, this is the neckline. Sorry, guys. I mean, it's just interesting to go back to this sort of stuff. This is the actual neckline, and then there's the right shoulder over there. Some people choose to sell there. Some people choose to sell at the break of the neckline. Okay, now that would be what's termed as a candlestick pattern, right? Because you're using the candlesticks to interpret and sort of like associate it with something that you're familiar with. Okay, now other ones would include a W type pattern or a double top. Okay, double top would be something along these lines where you have market rise, boom, pull back in, okay, hit that same area again, and then drop. Right, that would be a double top. Some people see an M. Right, really doesn't matter what name you sort of give it. It just achieves the same sort of outcome. Okay, does the same thing. And I'll go back a bit. Okay, and you can see here we have what some people have termed as a V bottom. Okay, this is what's called a V bottom. Market drops down, boom, forms what looks like a V shape. All right. Now, I'm not telling anyone to learn and go out and learn all of these patterns. Okay. There's quite a lot of them, and it would take time for you to become very proficient with all of them. However, the most easiest way, or the most basic way in which you can sort of like take these patterns and make them work for you is if you concentrate your efforts on a very few. Okay, perfect, Edmund. Good to have you. Okay, so you take few, perhaps one candlestick pattern, and you start utilizing that and just using it on a daily basis, testing it out. Okay, by testing it out, I don't mean just going into your demo and start trading it, that sort of stuff. That to me is not the first level of testing. Right? Testing needs to be back by using past data to firstly identify how efficient that pattern actually is. Okay. Because as much as we might like to think that every single thing we're going to try is basically going to work, but that is not the case. Because I know for a fact that some guys know some other stuff from YouTube, downloaded some stuff from this one, a friend shared this with with them and all that stuff. So there's a lot already going on in your minds. And what usually happens is your mind sort of like hates discarding information. Right? So you're going to try and use it somewhere. You're going to try and fit it somewhere, and it usually doesn't work. Right? The only way to sort of like get it out your system is to do some proper back testing and find and prove to yourself that the system or the trading methodology that you're currently using right now actually works. That's the only way. Right. Otherwise, you're just going to find yourself in a whole heap of trouble moving in between systems. Okay. So candlestick patterns they are, like I mentioned to you guys, the variance, but in a lot of cases, what you are trying to find can be explained as either a support or resistance level, okay, or a breakout into a support and resistance level. So this would be one of the most simplified methodologies or candlestick patterns that you might see. Right? Market breaks above, does look like also what some would call an upside down head and shoulder. Right? Market breaks above a previous support structure. You can see 163 even. Looks like a nice solid previous support structure because the market moved away from it aggressively. And it breaks above it, moves above it, and then comes back to retest that level. Okay. And you expect the market to move higher, right? So from that point over here, okay, you'd like to see the market extend higher, sort of like how we did here at this 62 even, so 162 even, market pressed above the previous resistance structure, pull back in, okay, rejection, boom, the market continued going higher. So that is a basic breakout candlestick pattern. And so if you want to take notes on that, that is a basic candlestick pattern that you can use on almost or just about any single market. Now, it's effective because in most cases, you're going to be trading in line with the overall trend. Number two, you're not going to be trading stagnant markets, which means if a market is ranging sideways, you're looking for something different each and every time in terms of candlestick patterns. So if the market is moving sideways, which means it's just staying in this range. So this is what the market does. Okay, this is what the market does for the next week or two. It would be completely ineffective for you to look for a breakout before that actually forms. All right, so then you substitute that breakout candlestick pattern you usually would have used in a trending market for, let's say, a double top or a double bottom. Okay, double top or double bottom is similar to, well, it's exactly like M or W. Okay, let me just highlight that M so you can see it. All right, there we go. There is an M. I have to remove this. Okay, so you'd be looking at a short or a sell at 16300 to make sure that you are staying in tune with the tone of the market. Okay, remember, sideways moving markets, you trade, let's say, an M or W candlestick pattern, and a breakout you usually, or a trending market, whether it's trending up or it's trending down, you're looking for the breakout candlestick pattern, right? So you can call it whatever you want, a V bottom, I don't necessarily care what you call it, as long as you take it, test it, use it effectively, and then just continuously make money with it. Okay. All right, guys. We're approaching about 4 minutes left. Okay, are there any questions, guys? Any questions whatsoever? Okay, so if there are no questions, I will be ending off tonight's session here. As I said, if you missed any parts of it, especially the beginning, then you will be able to watch the recording. I will upload it onto the YouTube channel and post the link in the Telegram channel so you'll be able to watch that. Okay, just watch it, rewatch it, take some notes, and I'll upload the PDF or the ebook for beginners in the Telegram channel so you can actually use it over the next couple of days in order to prepare for next week's session. Okay. So today, beginners, and tomorrow we're just having our normal advanced session. Now, I'm not quite certain about next week, Thursday. I will put in an announcement about next week, Thursday's session. I actually have something going on back at home, so I'll be heading there probably Thursday afternoon. And yeah, we have a bit of a traditional thing going on, so I will update everyone if I'll be able to make some time or push the session back to probably Sunday. I'm not quite certain. It should be done by Sunday, but I will make an announcement for that in the group. Okay. Okay, I mean, time frame doesn't really matter that much, okay? But like I always say, that the easiest and most effective way that you're going to be when it comes to analysis is if you break down from the higher time frame. Right? So you might use a daily, 4-hour, and 1-hour time frame. You don't want to use a lot of time frames, and you don't want to use a smaller time frames because the patterns are the flow of the market is very erratic, which means it doesn't have a lot of consistency. If you look at the 1 hour, at the 1 minute, for example, there's not a lot of consistency as opposed to the daily, because that's where a lot of the major players are actually playing it, right? The daily, the 4-hour, and the 1 hour. A lot of the 1 minute price action is just, I don't know, you can call it synthetic uptrends and downtrends or movement, basically. It's not real. Okay. So I think there's a video that I did that talks a lot about time frames, probably 2-3 weeks old. You just go back in the Telegram channel, you'll be able to find it. It just explains how to look at time frames, right? And how to decide which time frame is better for you, depending on the way that you actually want to trade, like short term, long term, or position trading. Okay. So we have less than a minute, guys, and I will be calling it a day. Trust everyone has a great evening. Thank you guys for coming through, and I will see you guys in the next session. All right. Cheers.